FIIs, FIIs,
FIIs,
FPIs,
FIIs,
foreign investors.
If you follow business news in India, whether it's TV, Twitter, or even your broker app, you must have noticed one pair of numbers that gets repeated every single day: the FII buy-sell figure and the DII buy-sell figure. Over time, these numbers start feeling like a scorecard. Who's buying today, who's selling, and is that why the market is going up or down? Behind these numbers are not just traders or market participants. They are the Goliaths of the Indian equity market. I'm talking about the foreign portfolio investors, FPIs, and domestic institutional investors, DIIs. These are institutions that collectively decide the liquidity, sentiment, and the direction of our markets. When they move, the market moves. Their actions don't just reflect what the market is doing, they shape what the market becomes. For investors and even policymakers, understanding how they behave is essential because these flows determine whether India is being seen as a long-term growth opportunity or just a temporary place to park capital. But what about traders and speculators? Do these numbers signal trends or offer an edge? That and more is what this episode is all about. I'm your host Sandeep Rao, and in this episode we are going deeper into how these two forces behave, what drives our markets, and how their push and pull gives the Indian market its balance. With that, let's get into it. To understand the full story behind FIIs in India, we would need to rewind to the early 1990s. India was just beginning its big economic reform journey, attempting to shift away from a closed, self-reliant model towards an economy that is more open towards foreign investments and markets. A major milestone in that transition came in September 1992, when India officially allowed foreign institutional investors or FIIs to invest in Indian capital markets. On a side note, if this part of Indian economic history interests you, I have a book and a website to recommend. The book is To the Brink and the Back, India's 1991 Story by Jairam Ramesh, and the 1991 Project Side by the Mercator Center. I'll share the links in the show notes. Back to FIIs, before September 1992, the only foreign money allowed in the markets was from NRIs and OCBs, which is Overseas Corporate Bodies. So imagine the stock market back then. Relatively shallow, limited liquidity, and mostly domestic participation. Then came September 14th, 1992, when the Government of India issued a press note that changed everything. For the first time, large global investors like mutual funds, pension funds, and asset managers were allowed to invest directly in Indian equities. Initially, they could buy shares, debentures, and warrants of companies that were either listed or about to list. The full regulatory framework came a few years later with SEBI's FII regulations in 1995, but the opening itself happened in 1992. Now, who were these early FIIs who came in? While I couldn't access a perfectly preserved public list of the very first registrations, financial historians generally agree that the first big entrants were mostly US-based institutional investors. Two names show up frequently: Templeton Asset Management, which later became Franklin Templeton, and Morgan Stanley Asset Management, and this one is especially important. In 1994, Morgan Stanley launched the Morgan Stanley Growth Fund, which went on to become India's first foreign-sponsored closed-ended fund. That was a big deal. Think of it as a signal to the world that Indian markets were now open, investable, and worth paying attention to. And the effect was immediate. When these early FIIs started deploying capital, the Indian market saw something they hadn't really experienced at scale before: deep foreign liquidity. This liquidity didn't just push prices, it accelerated market cycles, helping the market break out of slow consolidating phases and move into a more vibrant trading activity. With the backstory done, let me clarify some terms and abbreviations now. The first one obviously is FII, which stands for Foreign Institutional Investors. Now, this is a term that comes from the older pre-2014 regulatory framework. It included mainly foreign institutional investors like mutual funds, pension funds, and insurance companies and banks. Currently, the correct term would be FPI or Foreign Portfolio Investors, a term that came post-2014 regulatory overhaul, and FII is now just a subset of FPI. FPI today in a way is a super category that includes sovereign wealth funds, individual high net worth foreign investors and recognized institutional investors. So while in practice FII is a term that is still used, FPI is the correct official term. Next is the term DII, that stands for Domestic Institutional Investor. DIIs are a crucial segment of the Indian capital market, representing the domestic financial entities that invest in the local market. The primary components included under the DII umbrella are mutual funds, insurance company, pension funds, NBFCs, banks and other statutory bodies. Now do remember the term DII is an informal classification in the Indian capital markets, meaning it is not defined by a single unified regulatory category or a single registration process. In short, in today's context, it's FPI versus DII. That's the correct nomenclature. With the definitions and the abbreviations sorted, now let's move to the data and understand what this data actually means. Now, I'm sure you may have seen headlines like FIIs have been buying for 2 straight fortnights, or FIIs are net buyers for the past 2 days. Now the second one is actually worse. I'll explain in a moment why. But before we interpret any of these numbers, we need to understand something. We need to know what exactly is being reported, when is it being reported, and who is doing the reporting. For FPI flows, there are 2 different data sets. The first is provisional FPI data. This is released at the end of each trading day by the stock exchanges. It only reflects market trades executed during market hours. The second is final FPI data. This comes later from NSDL and CDSL. It includes everything: market trades plus off-market transactions and flows arising from corporate actions like buybacks, open offers and rights issues. So the final data is the accurate one, but the media usually quotes the provisional numbers because it comes one day ahead. Now for DIIs, it's different, because we only get provisional data, again published by the exchanges at the end of the day. Now in case of DIIs, there is no central authority that compiles a final consolidated DII data, the way it is for FPIs, because DIIs report to different regulators. Mutual funds report to SEBI, insurance companies report to IRDAI, pension funds to PFRDA, etc. This is why DIIs always aggregate and provisional, whereas FPI data has both provisional and final versions. Now comes the interesting part. We'll look at the FII and DII data for the past 15 years, that's over 3,000 trading days, and understand whether there is any pattern, story or signal hidden inside it. At a high level, here's what the data shows. Notice the blue line, which represents cumulative DII investments. You can see a clear uptrend starting from 2016 with only a brief pause around 2020 during the pandemic. After that, the trend doesn't just continue, it accelerates sharply, almost exponentially. You can also see the same trend in the bar chart, which makes the comparison with FPI flows even clearer. This is the year-on-year total net investments of FPIs versus DIIs. The shift becomes obvious around 2015. From that point onwards, DIIs have increasingly been driving the market. Now, this isn't new information. It has been widely reported in the media. In fact, throughout 2024, DIIs have not only been net buyers, but they've also been absorbing FPI selling pressure. As our finance minister put it, DIIs have effectively acted as shock absorbers for the Indian stock market. Now let's look at another chart. This is a bit different way of looking at the same data. This bar chart shows the percentage of trading days in each year when either FPIs or DIIs were dominant. Dominant here simply means on that day which side had larger net buying value. Now look at the blue bars, DIIs, from 2015 onwards. They consistently exceed the yellow FPI bars. In other words, on more days each year, DIIs were the ones driving net positive flows. All of this points to one conclusion. There has been a structural shift in how our markets are funded. Look at what's happening right now. Foreign investors have withdrawn nearly 1 lakh crore from Indian equities this year, driven by tariff uncertainty and a weaker rupee. But domestic institutional investors, backed by steady SIP flows and insurance money, have absorbed nearly all of that selling and kept the market stable. The result is quite historic. DIIs now own 17.62% of the Indian equities, surpassing FIIs at 17.22% for the first time ever. FIIs still do influence short-term volatility, I agree, but the growing domestic investor base is now acting as a stabilizer, making our markets more resilient, less externally dependent, and increasingly driven from within. Now let's go a level deeper and examine the flows week on week to see if there is any meaningful pattern that emerges. Now here's the approach that I would follow. For each week, I identified who is dominant, FPIs or DIIs, based on net buying. That week is labeled as week 0. Week 0, that is W0, itself isn't tradable information, it's just a signal. But then I looked at what happens next. Week +1, which is the following week, and week +3, which is the next 3 weeks. The question is, does dominance in week 0 give us any edge in predicting returns in the weeks that follow? Now, what we see is that FIIs do have an impact in the same week they are buying. The market tends to respond while they are active, but that effect doesn't carry forward into the following weeks. On the other hand, DIIs don't always move the markets immediately, but their flows show a more sustained follow-through over the next few weeks. However, knowing just this doesn't really translate into any kind of a trading edge. Even though the pattern is interesting, it does not outperform simply following the price itself, whether you are running a systematic strategy or just buying and holding Nifty. Now that we have looked at the FII and DII data on a weekly time frame, let's look at it at a much more granular level, that is on a daily time frame. This time around, I split the data into two regimes, pre-2016 and post-2016, to see whether there is any structural shift that we can observe. I categorize days again based on FPI dominant days and DII dominant days. So that's what you see now. FPI dominant days were days where the net FPI buying was positive, and DII dominant days are days where the net DII buying was positive. So here's what stands out. On FPI dominant days, the market tends to react on the same day, which is T0. But since T0 is already over, it's not tradable. Beyond T0, there is no statistically significant follow-through. On DII dominant days, there's a small improvement. The median return on T0 shifts from slightly negative to slightly positive post 2016. But again, there is no meaningful follow-through into T+1, T+3, etc. So bottom line, whether it is FII net daily data or DII net daily data, none of these translate into any kind of a strong trading edge. So what's the conclusion? If you are a trader hoping to find a signal in the daily FPI versus DII buy numbers, then I'm sorry to disappoint you. There is no actionable pattern there. This is something most experienced traders kind of suspected intuitively, but now we also have the data to back it up. Of course, this analysis was only on the cash market flows. There might be something if we break it down by sectors or look at the derivatives positions. I don't know yet, and that's something I'll explore in the future episodes. But for now, the conclusion aligns perfectly with the old Gujarati saying, Bhav Bhagwan che, price is God. If you're looking for an edge, look at the price, because at the end of the day, price is the only thing that pays. Now that brings us to the end of this episode, and I hope you found this episode valuable. Do share your questions, thoughts, and feedback in the comments. I'll do my best to respond. Thank you for watching, and see you in the next one.